Real estate without passive income is a sure way to failure. Any successful real estate investor knows that. That's at least what one of you guys suggested on the Perfinex channel. Since you asked for my opinion, I kind of agree. Kind of. But it's not as easy as it seems. Let's clarify the relationship between real estate and passive income in this episode of the GermanReal.Estate FAQ. I understand the nature of your comment. You want to invest in real estate, which costs a lot of money in the first place. The lowest is 5.5% in closing costs on top of the property value, could also be 15%. Let's just take 10% as a rule of thumb for taxes, notary fees and real estate agent. That's a lot of money that you need to save before buying a property. And now you should also invest more on a monthly basis? What? Not just that you have to invest tens of thousands of euros in the beginning, you also need to put a couple of €100 more into the property every single month. That's pretty bad for multiple reasons. First, how are you supposed to buy multiple properties like this? If a property is costing you €250 monthly, just as an example, 2 properties cost you €500 already, and 4 properties €1,000 every single month. Who's supposed to pay for this? And with every property you buy, your creditworthiness goes down and down, which is the exact opposite of what you want when investing in real estate. Second, if your entire real estate strategy is dependent on your income, what if your income goes away for whatever reason? You lose your job, you get sick or disabled, your company goes bankrupt and lets you go, whatever. Then your properties eat your savings, and as soon as they are gone too, you are forced to sell your property or it goes into foreclosure and the bank will sell it for you. If you sell with a profit, good for you, but maybe you have to pay taxes. But maybe the real estate market has been going down and it's a really bad time to sell. So you're actually forced to sell with a loss. So I think we can all agree on this one. Best case scenario would be to get 110% financing that also covers the closing costs and get a positive cash flow from the property from day one. The property pays all for itself and we don't have to invest a single cent of our own money. But how realistic is that? Buying a property that is cash flow positive and generates passive income sounds easy, but it's actually not. In order to be cash flow positive, a property needs to generate more rental income than expenses. Usually 2% principal because the bank that gave you a mortgage wants its money back. You're also not getting the mortgage for free, you have to pay interest. The current realistic interest for mortgages is around 4%. The interest rate table on our website will show you the current interest rate whenever you are watching this video. Whatever you see in the table is what I call marketing interest rate. Usually nobody gets an interest rate that good. So let's calculate with 4% here. 4% is also the interest rate that our Welcome Home Security Token pays to investors. So when you're on our website anyway, why not check out the currently available investments as well? 2% plus 4% is 6% of the property value that you need to pay to the bank every year. Those are the hard facts. On top of that is maintenance, renovations, management, potential vacancies that will cost you additional money. Let's have a very optimistic calculation and leave this at 0. Super unrealistic, but whatever. You still need to find a property with a 6% return on rent just to cover the mortgage. Where in Germany do you find a property with a 6% return on rent? I can tell you, only in the regions where renovations and vacancies will eat you alive. German property prices have outpaced rents over the years by a lot, making it very unrealistic to find a cash flow positive property. Here's proof from the Postbank Wohnatlas 2022. This Germany map shows you the Vervielfältiger, the multiple that divides property prices by net rent. A property worth 100k returning 10k in rent has a return of rent of 10% and a multiple of 10. A property worth 100k returning 5k in rent has a return on rent of 5% and a multiple of 20. A property returning 6% return on rent, which is the absolute minimum we would have to be looking for, is a multiple of 16.7. That leaves us with the dark green areas that have a multiple smaller than 22.5. 16 is not even on that list. And the A and B locations most of you guys are looking at are dark red with a multiple of at least 32.5. That's a maximum of 3% return on rent, not a minimum of 6%. So, how do we deal with this now as real estate investors? If I were you, I wouldn't focus too much on a positive cash flow. Let's imagine you find a 1 in a million property that returns 7%. Would you buy it? Hell yeah, you would, because it returns passive income. But if you increase the principal you pay the bank from 2% to 4%, your 1 in a million property is suddenly cash flow negative, even though nothing fundamentally changed with the property. And that shows you the pitfall with cash flow, especially for new real estate investors. You have to look at why there is no passive income in the beginning. Maybe you are buying a property in the city center of an A location, hoping for a big increase in property value. If you are missing €2,000 cash flow a year compared to an average property, while your property rises €5,000 a year compared to an average property, it's a fine trade-off, isn't it? Especially because your risk for vacancy is virtually non-existent for good properties in the middle of Frankfurt, Berlin or Munich. You might find a property with an 8% return on rent in the middle of nowhere. But if you don't find a tenant, your 8% becomes 0% pretty quickly. So to me, buying a property with a negative cash flow is fine, if you know how to manage the risk and you know what to do in order to turn that negative cash flow into a positive cash flow in a reasonable time frame. The pre-tax cash flow might take a while until it actually becomes positive and you start making real passive income on a monthly basis. The after-tax cash flow, after you deducted all your costs from the property, will turn into a positive cash flow much faster. But real estate taxation is maybe a topic for a different video. By the way, properties that you find on our GermanReal.Estate marketplace are returning a positive cash flow from day one. How is that possible? We don't have bank credits because you guys invest in our real estate security tokens. So we can give interest to you instead of paying it to a bank. And we much rather give you 4% than give 4% interest to any bank. So why don't you hop over to our website GermanReal.Estate and see what investments are currently available.